ExamPrep.School. Wyoming Life Insurance Producer Exam. Exam code 12-WY-1 or OP-WY-01. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Application, underwriting, and policy delivery. Life provisions, riders, options, and exclusions. Retirement and other insurance concepts. Types of policies. Wyoming statutes, rules, and regulations common to all lines. Wyoming statutes, rules, and regulations, life insurance. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which of the following most accurately defines level term life insurance? A. A term policy that renews annually at a higher premium reflective of attained age. B. A policy with a death benefit that decreases over time while premiums remain level. C. A policy that provides a predetermined death benefit and level premiums throughout the initial guaranteed period. D. A policy feature allowing conversion to a permanent plan without evidence of insurability. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is C. The correct answer is a policy that guarantees both a fixed death benefit and fixed premium payments for the duration of its initial term before any renewal adjustments. Reason A is not correct. Describes annual renewable term where premiums increase each year. Reason B is not correct. Describes decreasing term which has a declining benefit, not level term life. Reason D is not correct. Describes the convertible option feature, not the definition of level term itself. Question 2. In an annual renewable term policy, how do premiums change over the coverage period? A. Remain level during the initial term and adjust only upon conversion. B. Stay fixed for the entire policy duration regardless of age. C. Decrease annually as mortality risk reduces. D. Increase each year based on the insured's attained age. The correct answer is D. The correct answer reflects that annual renewable term premiums rise each year because they are recalculated based solely on the insured's current age at each renewal. Reason A is not correct. Level initial premiums that change only on conversion don't describe annual renewability. Reason B is not correct. Fixed premiums throughout contradict the annual recalculation feature. Reason C is not correct. Decreasing premiums contradict the increasing mortality costs with age. Question 3. Which step correctly describes exercising a convertible term option in a term life policy? A. Filing a new application with medical evidence at the end of the initial term. B. Requesting a benefit increase during the conversion period without additional premium. C. Notifying the insurer during the specified conversion window without proof of insurability. D. Waiting until policy expiration to apply for a permanent policy at age 65. The correct answer is C. The correct answer captures that conversion requires timely notice given during the conversion period and does not require new evidence of insurability. Reason A is not correct. Conversion does not require submitting new medical evidence. Reason B is not correct. Conversion adjusts contract form, not benefit increase without premium. Reason D is not correct. Conversion must occur before expiration, not deferred until age 65. Question 4. What best describes a decreasing term life policy used for mortgage protection? A. A policy that builds cash value while level term declines. B. A term plan with premiums that decrease as the mortgage is paid. C. A policy where the death benefit diminishes over time in line with the mortgage balance. D. A level death benefit policy convertible to a decreasing term plan. The correct answer is C. The correct answer explains that in mortgage protection decreasing term, the death benefit declines over the term to match the outstanding loan balance. Reason A is not correct. Decreasing term does not build cash value. Reason B is not correct. Premiums typically remain level even though the benefit decreases. Reason D is not correct. Decreasing term is not a conversion of a level benefit policy. Question 5. A 30-year-old purchases a 20-year return of premium term life insurance policy. At the end of the 20-year term, the policy remains in force and no death benefit has been paid. Which of the following statements best describes the refund feature of this policy? A. The insurer returns all paid premiums as a cash refund on a tax-free basis. B. The insurer pays a reduced death benefit equal to the total premiums paid if the insured dies during the term. C. The policy accumulates cash surrender value equal to the paid premiums plus interest. D. The refunded amount is considered taxable income to the policy owner. The correct answer is A. The return of premium feature reimburses all cumulative premiums paid at the end of the term if the insured outlives the policy, and this reimbursement is generally treated as a non-taxable return of capital. Reason B is not correct. This statement conflates return of premium with an increased death benefit provision, which is not offered by this rider. Reason C is not correct. A term policy with a return of premium feature does not build cash surrender value or accumulate interest. Reason D is not correct. The refunded amount is typically treated as a return of capital and is not taxable income. Question 6. A 45-year-old insured with a 10-year renewable term policy approaches the re-entry option at the end of the initial term. Which underwriting requirement must the insured satisfy to obtain renewal under the re-entry provision? A. Demonstrate insurability through proof of good health at specified re-entry dates. B. Accept premium rates based on the original issue age regardless of current health. C. Convert the term policy to a whole life policy without evidence of insurability. D. Provide 3 years of continuous coverage without any lapses to qualify. The correct answer is A. Under a re-entry option, the insured must provide evidence of insurability, typically via proof of good health or medical exam at designated intervals, to renew at favorable rates. Reason B is not correct. Premiums under a re-entry provision are based on attained age upon proof of insurability, not the original issue age regardless of health. Reason C is not correct. Conversion to whole life without evidence of insurability is a separate conversion privilege and not part of the re-entry option. Reason D is not correct. Continuous coverage duration does not satisfy the medical underwriting requirement for re-entry. Question 7. According to the standard non-forfeiture law, what is the minimum guaranteed cash surrender value at the end of the third policy year for an ordinary whole life policy, expressed as a percentage of total net premiums paid? A. 70%. B. 80%. C. 90%. D. 100%. The correct answer is C. The standard non-forfeiture law requires that the guaranteed cash surrender value at the end of the third policy year be at least 90% of total net premiums paid. Reason A is not correct. This percentage corresponds to the second policy year, not the third. Reason B is not correct. An 80% value is not a statutory minimum at any standard policy year under the law. Reason D is not correct. A full 100% value is guaranteed only after the third policy year, not at its end. Question 8. Which description most accurately characterizes the premium structure of a limited pay whole life insurance policy? A. Level premiums payable until the insured reaches age 65. B. Level premiums payable for a predetermined number of years shorter than the coverage period. C. A single lump sum premium paid at policy inception. D. Flexible premiums that vary based on the policy's cash value performance. The correct answer is B. A limited pay whole life policy features level premiums payable only for a specified period shorter than the policy's full coverage term, after which no further premiums are due. Reason A is not correct. Premiums are not limited to an age milestone but to a specified time period. Reason C is not correct. A single lump sum premium describes a single premium policy, not a limited pay plan. Reason D is not correct. Limited pay premiums remain level and do not fluctuate with cash value performance. Question 9. Under the IRS 7 pay test, a single premium whole life policy will be classified as a modified endowment contract because the single premium payment exceeds the net level premium required to pay up the policy in how many years? A. 1 year. B. 5 years. C. 7 years. D. 10 years. The correct answer is C. The 7 pay test defines a modified endowment contract as one where cumulative premiums exceed the net level premium needed to pay up the policy within 7 years. Reason A is not correct. A single premium fails the test immediately but is measured against a 7-year benchmark, not 1 year. Reason B is not correct. 5 years is not the IRS standard period used for the 7 pay test. Reason D is not correct. 10 years exceeds the regulatory test period. The IRS uses a 7-year schedule. Question 10. Which statement best describes the maturity benefit under an endowment at age 65 contract? A. Payment of the cash surrender value to the policy owner and continuation of coverage. B. Conversion of the policy to extended term insurance until age 100. C. Payment of the full face amount to the insured at age 65, terminating the contract. D. Waiver of future premiums with no living benefit until death. The correct answer is C. An endowment at age 65 policy matures at that age by paying the full face amount to the insured, and the contract terminates. Reason A is not correct. The cash surrender value is lower than the face amount and does not continue coverage. Reason B is not correct. Extended term applies when a policy lapses, not at endowment maturity. Reason D is not correct. Premiums are not waived. The policy simply matures and pays out the face amount. Question 11. An insured has a participating whole life insurance policy with a $150,000 face amount and $45,000 cash value. The insured takes a policy loan of $25,000 and does not make any payments on it. At the insured's death, how will the outstanding loan affect the death benefit payable? A. The death benefit is reduced by the original loan amount. B. The death benefit is reduced by the loan plus accrued interest. C. The death benefit remains at $150,000 with the loan repaid from the cash value. D. The death benefit is paid in full and the loan is repaid from any dividends. The correct answer is B. The outstanding loan plus interest reduces the policy's death benefit at claim. Reason A is not correct. This distractor ignores that interest accrues on the loan, which further reduces the benefit. Reason C is not correct. This distractor incorrectly assumes the loan is repaid solely from cash value rather than reducing the benefit. Reason D is not correct. This distractor suggests dividends are used to settle loans at death, which is not standard. Question 12. An insured holding a participating whole life policy elects the paid-up additions dividend option. What immediate effect does this choice have on the policy? A. Reduces future premium payments by crediting dividends to premiums. B. Purchases additional paid-up whole life coverage, increasing death benefit and cash value. C. Leaves dividends in a deferred account earning interest. D. Uses dividends to reduce any existing policy loans. The correct answer is B. Paid-up additions option uses dividends to purchase single premium, additional whole life coverage, boosting both cash value and death benefit. Reason A is not correct. This distractor describes the premium reduction option, not paid-up additions. Reason C is not correct. This distractor refers to the accumulation option, not paid-up additions. Reason D is not correct. This distractor describes automatic loan repayments, not the paid-up additions option. Question 13. What distinguishes an immediate annuity from a deferred annuity? A. Interest rate calculation method. B. Timing of the income payout. C. Frequency of premium deposits. D. Amount of required cash surrender value. The correct answer is B. The correct answer is the timing of the income payout, because an immediate annuity begins payments within 1 year of purchase, while a deferred annuity starts payments after a longer deferral period. Reason A is not correct. The interest rate calculation method can be similar for both types and does not define their difference. Reason C is not correct. Both immediate and deferred annuities can be funded by varying deposit schedules. This is not the defining characteristic. Reason D is not correct. Cash surrender values may differ by contract, but are unrelated to the distinction in payout start timing. Question 14. Which feature primarily differentiates a single premium annuity from a flexible premium annuity? A. The schedule of premium payments. B. The method used to calculate mortality charges. C. The tax treatment of distributions. D. The length of the surrender charge period. The correct answer is A. The correct answer is the schedule of premium payments because a single premium annuity is funded by one lump sum payment, whereas a flexible premium annuity allows multiple premium contributions over time. Reason B is not correct. Mortality charge calculations do not differ based on premium funding structure. Reason C is not correct. Tax treatment of distributions is generally the same for both funding types. Reason D is not correct. Surrender charge periods are contract features but do not define single versus flexible premium structure. Question 15. In a fixed annuity contract, what does the interest rate guarantee represent? A. The minimum rate credited to the contract for a specified period. B. The maximum rate the insurer can apply to the contract. C. The interest rate applied only at annuitization. D. The rate tied directly to a stock market index performance. The correct answer is A. The correct answer is the minimum rate credited to the contract for a specified period, because fixed annuities guarantee a floor interest rate for the duration of the guarantee period, regardless of market fluctuations. Reason B is not correct. The maximum rate is not guaranteed, only a minimum rate floor is. Reason C is not correct. Guarantees apply during the accumulation phase, not solely at annuitization. Reason D is not correct. Rates tied to a market index describe equity-indexed annuities, not standard fixed annuities. Question 16. What is the purpose of the separate account in a variable annuity? A. To hold investments whose performance determines contract value, separate from the insurer's general account. B. To secure the insurer's general account liabilities in case of insolvency. C. To provide a guaranteed minimum death benefit regardless of market performance. D. To segregate the annuity's fees from its investment returns in the insurer's general account. The correct answer is A. The correct answer is to hold investments whose performance determines contract value, separate from the insurer's general account, because variable annuity benefits fluctuate based on those separate account assets. Reason B is not correct. Separate accounts are not designed to secure general account liabilities. Reason C is not correct. Guaranteed death benefits come from contract provisions, not the separate account itself. Reason D is not correct. Fee segregation is a contractual detail, not the primary purpose of separate accounts. Question 17. Carlos purchases an indexed annuity tied to the S&P 500 and notices that although the index gains 14% in a year, only a portion of those gains will be credited to his account. Which annuity contract feature specifies the percentage of index gains credited? A. Cap rate. B. Participation rate. C. Spread. D. Floor rate. The correct answer is B. The participation rate determines the proportion of the index's positive performance that is credited to the annuity. Whereas a cap rate sets a maximum credited interest, a spread is deducted from index gains, and a floor rate guarantees a minimum interest. Reason A is not correct. A cap rate limits the maximum interest credited, but does not define the proportion of index gains. Reason C is not correct. A spread is subtracted from index gains rather than specifying the share of gains credited. Reason D is not correct. A floor rate sets a minimum guaranteed interest level, not the percentage of positive index performance credited. Question 18. Natalie and Marcus purchase a joint life first-to-die whole life policy to cover their mortgage payments. If Marcus dies first, which outcome accurately reflects how the policy operates? A. The death benefit is divided equally between the two insured's beneficiaries upon first death. B. The insurer pays the full death benefit, and the surviving policy owner may convert the policy's cash value into an individual contract. C. No death benefit is paid until the surviving insured dies. D. The insurer pays the full death benefit to the beneficiary and the policy terminates. The correct answer is D. A joint life. First-to-die policy pays the death benefit when the first insured dies and then terminates, without continuing coverage or splitting benefits among lives. Reason A is not correct. The death benefit is paid in full at first death. It is not divided between beneficiaries. Reason B is not correct. Conversion to an individual contract is not available because the policy ceases upon first death. Reason C is not correct. A last-to-die policy defers payment until the second death, unlike a first-to-die contract. Question 19. According to the entire contract clause in a life insurance policy, which of the following is considered part of the contract? A. The policy, the application, and any attached riders. B. The written application and any attached riders. C. The policy and all endorsements issued with it. D. Oral statements made by the agent before policy delivery. The correct answer is A. The entire contract clause binds the insurer to the policy, the application, and any attached riders or amendments as the complete agreement. Reason B is not correct. This omits the policy itself, which must be included in the contract. Reason C is not correct. This omits the application, which is expressly included by the entire contract clause. Reason D is not correct. Oral statements are not part of the written contract under the entire contract clause. Question 20. Which phrase typically appears in the insuring clause of a life insurance policy? A. We will pay the sum insured to the beneficiary upon receipt of proof of death of the insured. B. This policy may be converted to a permanent plan at any time. C. No suit shall be brought unless commenced within 3 years. D. If the insured fails to pay premiums on time, the policy may lapse. The correct answer is A. The insuring clause contains the insurer's promise to pay the death benefit to the beneficiary upon proof of the insured's death. Reason B is not correct. This describes a conversion option, not the insurer's promise to pay in the insuring clause. Reason C is not correct. This is a limitation of time for legal action, not part of the insuring clause. Reason D is not correct. This refers to a lapse provision, not the insurer's payment guarantee in the insuring clause. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.